that kind of stuff. Before we get started, I'm going to, oh, hang on, sorry, that button. I'm just need to give you the standard disclaimer. As you are probably aware, thanks to the Royal Banking Commission and things like that, the government, etc., has gone overboard in the red tape for financial planning. So you need to understand that this is just a summary presentation only. It's tax facts, not personal advice. And just because you can do something doesn't mean you should do something. And even then, the rules change so fast. Please make sure you double check with us before you actually make any contributions that you're worried about at all. If you want to make sure something is effective for you, then you need to give us a call. And then, because nobody ever reads the disclaimer, just expanding on that a little bit more, I just want to make it crystal clear that superannuation is a long-term investment for your retirement. And even though it's, it is usually the most tax-effective way to save up for your retirement, but then the money is locked up until you meet a condition of release. So, for example, that's reaching age 65 or reaching preservation age and retirement. And there's a couple of other ones as well. But this means that if you're going to need the money sooner, be that for debt reduction, house renovations, kids' education, etc., then you need to talk to a licensed financial planner. So come and talk to Bob at Everalls Wealth Management about what the best strategy is for you and level of contributions perhaps that is needed for you to achieve your financial goals. So again, just because you can put money into super doesn't mean you should. And as I mentioned before, just drumming it into you, the rates, the thresholds, the caps, the age limits, the other rules, work tests and all that kind of stuff do change frequently. Legislation is being updated regularly. So please ensure that you get professional advice before making any contributions. Now, and the other reason for being careful is because if you do end up going over some of the contribution caps, you can be subject to extra tax penalties and interest. So it's really important that you're careful. One other thing to think about too is that if something happens to you, where is your superannuation going to go? So it's terrific putting all this money into superannuation, but as part of your estate planning purposes, for example, it's a really good idea to make sure that you are clear about who your superannuation beneficiaries are, binding death benefit nomination forms and all that kind of stuff. So if you've got some spare time over the next week or two or three, maybe that's something that you could turn your mind to at some stage. And of course, putting all this money into your super fund is one thing. Making sure it is working hard for you while it's in there is critical as well. So do make sure that you review your superannuation investment strategy regularly. It might change perhaps because of the markets and what things are doing. It might change because of the amount of money you have in your super fund. So as your super fund grows, there might be more effective investments to get into. Or as you age, perhaps there are different strategies that are more appropriate for you. So do keep an eye on that and review it regularly. So getting into the interesting stuff. Today, we're going to cover three main areas across 10 different ways to boost your super. We've broken it down into the employer contributions, personal contributions, and other contributions. So let's have a look at those in a bit more detail. There you can quickly see, so we've got the employer contributions are going to be the SGC and the salary sacrifice. Then you've got your personal tax deductible contributions, the concessional ones, and the new catch-up provisions. And then you've got your after-tax non-concessional contributions as well. Then we've got spouse contributions, spouse super splitting contributions, the government co-contributions, downsizer contributions, and then if any of you are in small business, there's ways we can take most of your capital gain on sale of your business for example, when you retire, and get that into your super fund effectively tax-free as well. So we'll have a quick look at that at the end. So let's look at the employer ones first. The super guarantee charge is a compulsory superannuation payment that your employer has to make for just about all employees. It's based on ordinary time earnings, so not overtime, obviously, but pretty much everything else. If you worked for it, then you get your SGC on it. The government has restarted the indexing. It's now 10%, and it's scheduled to go up by 0.5% every year for the next few years until we get to about 12%. About right, but it's only legislated to about 12 at the moment. There is no age limit anymore on your SGC. So if you're so inclined as to keep working until you're 75, 80, 90, you can still get your compulsory superannuation guarantee charge payments on your wages. Super guarantee charges, so when the money goes into your super fund, it gets taxed 15%, and the super fund sends that off to the ATO for you. Some of you might have, and that's where if your total adjusted income plus superannuation is more than 250,000, then they'll actually send you a separate invoice for an extra 15% on your superannuation contributions for the year, and you pay that personally, or you give it to your super fund and get them to pay it for you. But either way, whether it's 15% or 30%, that's usually much better than our clients' average tax rate of, say, 47%, or even 34.5%, that kind of thing. Just noting there that technically at the moment, employers don't have to pay SGC if your monthly wages are less than $450 in a month, but there was talking it payable from the first dollar, maximum amount of SGC that an employer has to pay, and that maximum at the moment is 23,568, but 99% of the time, from what I can see, employers just pay the flat rate because it's all just part of your package. So that's your SGC. In terms of salary sacrifice, as an employee, you can obviously voluntarily elect to have some of your tax before tax pay. So you salary sacrifice some of your salary, and your boss puts that into your super fund instead, in addition to the SGC amounts. There's a trick though. It has to be documented in advance. What this means is, for example, if you've got an employee who's been working away all year, been doing really well, you've been paying their 10% super, and you decide to give them a bonus. If you tell them, here's a 10 grand bonus, and they say, oh, gee whiz, thanks very much, I want to put that into my super fund, it's too late, if you like. The black letter of the law says they have to have a salary package document put in place, for example, at the beginning of the financial year, that says, this is what my salary package is. And by the way, if I get any bonuses, I want them put into super. So just be aware of that. And either way, if you do have anybody salary sacrificing, for example, even on a regular basis, then make sure it is documented somehow, on their file, etc., that they've actually applied to have that. Just in case the ATO decides to get pedantic. The salary sacrifice contributions are treated exactly the same way for tax purposes. So the same 15% upon entry into the super fund, if you like, that the super fund sends off to the ATO. And then if you're a high income earner, the ATO, once you've lodged your tax return, they'll send you a bill for the extra 15%. Please note that the maximum concessional contribution cap from 1 July 2021 is now 27,500 per person. It used to be 25 grand, but it's gone up now. But that 27,500 cap includes all of the SGC and any other personal concessional contributions that an employee might like to make, which we'll talk about in a second. But it does mean you have to be a little bit careful about making sure that you don't go over the threshold. There is a limit on how much you can salary sacrifice, in terms of eligibility, and that is if you're 67 to 74, you must pass or be exempt from the work test. Now, logic kind of says, well, if you're salary sacrificing, you're obviously working, but the trick is to make sure you're working the 40 hours in the 30-day period, that kind of thing. But do note the important bit there is that you can't salary sacrifice anything if you're 75 or over. And we do actually have a couple of clients who are still keeping their hand in on that front, so it is relevant from time to time. So that's salary sacrifice. There's a slim chance I might be coordinated enough that if anybody has any questions, put them in the chat box and I'll see if I can answer them as I go. The insurance premium one, Linda, make sure I come back to you on that at the end. But yes, it does. It's definitely part of the 27,500. So let's have a look at personal contributions then. So these are the ones that you can voluntarily make a superannuation contribution into your fund, and you can claim a tax deduction for it. Same as the employer contributions, they're taxed at 15% as the money goes into the super fund. So super fund sends that off to the tax office for you. And at the end of the year, when you lodge your tax return, if you're a high income earner, the ATO will send you the bill for the extra 15%, the Div 293 tax. As I said before, you can pay that personally or you can get it deducted from the super fund. But either way, if you're on the top tax bracket or even, more than about 80 grand a year, your personal tax rate is going to be more than 34.5. So again, that's why it's so tax effective to invest via your super fund instead of in your own name, if you can afford the money to be locked up until retirement. So it's the same 27,500 cap, not a different one. All these ones are the same 27,500. And answering your question, Linda, yes, it does include the insurance premiums for insurance that's held inside superannuation. So some people do have their personal insurances held effectively by a superannuation fund. So the super contributions that you make to the fund that are then spent on the life insurance, etc. premiums, those are still super contributions and therefore count for this cap. When you're making these voluntary contributions, if you're between 67 and 74, so that's gone up recently from 65, but if you're between 67 and 74, you must pass the work test or be exempt from the work test, and we'll be covering that in a little bit more detail in a second. Remember, there are no contributions if you're 75 or over, and if you're 74, the contribution must be received within 28 days of the end of month in which you turn 75. Okay. Just making sure we're all good. Okay. Now, if not, Rob's kindly pointed out that if you're not claiming your insurance premiums, even though they're held within a superannuation fund, then they will count as a non-concessional contribution that we'll get to in a second. Is it different from paying premiums to external? I'll have to come back to you on your insurance stuff, Linda. Okay. Now, this one's relatively new. So we've said it's 27,500 per year that you're allowed to contribute to your superannuation fund, as that combination of SGC, salary sacrifice, and personal deductible contributions. They changed the rules or introduced new rules a couple of years ago, and now they let you carry forward the unused amounts for 5 years on a rolling basis. So when they started that in July 18, which is the 2019 financial year, so whatever you didn't use in 2019, you could then catch up on in 2020. And that's why 2020 is the first year you could effectively access this new strategy. The trick is that your total superannuation balance at the end of 30th of June of the previous financial year must be less than $500,000. If you've got more than that in your super fund, you can't do catch-up contributions. And this is a great tool for example, offsetting capital gains, or if you have a really good year, then you might want to put a little bit in extra into super to manage your tax bills. I've got an example here. So example, in 2019, Sam's got 10 grand SGC. So in those days, the cap was 25 grand. So he's got 15K unused. And just for this, keeping it simple, 2020, he's got 11 grand SGC, so 14K unused. 2021, 12 grand SGC, so 13K unused. So that means now this current financial year, he's got total unused of $42,000. 30th of June, let's say his total super balance is less than $500,000, so that he's eligible to use these catch-up contributions. Let's say he sells a rental property, so he's got a capital gain and some spare cash. He can then contribute 42 grand to be those unused contributions, as well as obviously top up whatever employer SGC contributions he's got available this year, and top that up to 20. So he declares his capital gain, but then claims an offsetting tax deduction for all the money he's put into his super fund. So this catch-up contributions were introduced. So for example, if you had a quiet year, took a year off, maternity leave, all that kind of stuff, then you would be able to catch up on your superannuation contributions in a later year. So it is only 5 years. And what you might need to be careful of is if your total super balance actually goes over $500,000 at some stage, you might actually end up with unused contributions that you can't actually claim. One of the examples on the ATO website actually shows how, for example, somebody went over $500,000. So there was 1 year where they weren't eligible to claim, but then say, thanks to COVID and I don't know, a stock market crash, the balance went down below $500,000, meaning that they were then able to claim again the next year. So keep an eye on that. Keep an eye on your total super balance. It's a rolling 5 years, so that when you get to 5 years down the track, so for example, when Sam gets to 2023, the 2009, anything unused from 2019 will fall off, and he'll just keep going from there on. So hopefully that makes sense. But yeah, just be careful. Let's just take a break from contributions for a second in terms of talking about the work test. So contributions, as well as non-concessional contributions that we're going to get to in a second, salary sacrifice contributions, and spouse contributions. So if you're under 67, there's no work test. You can make personal contributions to your super fund even if you're not working. But the minute you do get to 67, and up until age 74, you can only make a personal super contribution if you have been gainfully employed for at least 40 hours over 30 consecutive days during the financial year. Now, in plain English, what that means is you can work 1 week in a month, or you can work, for example, 10 hours per week for 4 weeks, being your 30 consecutive days, and you'll have passed that test. The tax office is also amazingly generous with their definition of gainfully employed. We've heard stories that babysitting, for example, as long as you get paid, so you could have been a high-flying exec or whatever, and if you go and babysit the grandkids and get paid for that for 40 hours over the school holidays or something, and can provide evidence of that, that apparently counts. We've also heard if you sort of run a bit of a hobby business, and go off to the markets and sell stuff, if you can show that your business has occupied you for 40 hours in the month, then that might also qualify as well. So, there's a lot of grey area in there about the definition of gainfully employed. So, and lots of case studies that you can look up to see. I think we don't want you pushing it, but anyway, there is some flexibility there. Now, the other option too is that they introduced a rule a couple of years ago to basically give everybody a 12-month extension on the work test. So you can actually be exempt from the work test. And this is what that looks like. So from 1 July 2020 onwards, last year, super funds can accept voluntary contributions for an extra 12-month period from the end of the financial year in which you last met the work test. So it just gives you, if you met the work test one financial year, you're allowed to, you're deemed to have passed the work test, or at least be exempt from it for the next 12 months. But it's a once-off thing. You can't have relied on the exemption in a previous financial year. And to be eligible to use the work test exemption, you must have a total super balance of less than $300,000 on 30th of June, the year before you make the contribution. So that introduction of that exemption from the work test has been very handy for people who have retired. It just gives you that one extra year to get some money into your super fund. Okay, now since we've been talking about all these concessional contributions, the issue here is to be really, really careful that you don't go over the 27,500, because otherwise you get hit with the excess contribution charge, and all the excess contributions are added onto your assessable income. So the tax office basically issues you with an amended assessment, including those excess contributions in your taxable income, taxes at your marginal tax rate, but at least they give you a credit for the 15% tax that the super fund's already paid. So yeah, just a reminder, don't go over your 27,500. All right. So all of those contributions we've been talking about are the tax deductible kind of contributions. Now let's have a look at the non-concessional ones. These are the ones that you pay for voluntarily out of your after-tax dollars. Sometimes the boss, as part of your pay allocations, the boss actually pays these for you, but they're definitely different to the salary sacrifice ones. So after-tax contributions, no deduction for them, but the advantage, though, is that when they go into your super fund, they don't get taxed at all. So you've paid for them out of after-tax money, so they don't need to be taxed in the super fund. So super fund statements, you'll see those taxed and untaxed kind of categories in your account. So these are the tax-free ones. You still need to pass that work test or be exempt from it if you want to make non-concessional contributions. The trick with non-concessional contributions now, $7 million at 30th of June the year before. So you wait to see what your annual statement shows the balance of your super fund is. And if that's less than 1.7 million, then you know you can do your after-tax contributions the following year. The threshold has just been increased for NCCs. So now the maximum is 110,000 per year instead of just 100,000. But your cap can actually be higher if you're eligible to use the bring forward arrangement. So let's have a closer look at that. Yeah, the total super balance has to be less than 1.7 million, the balance of the fund at the 30th of June. And it's the total super balance is all of your super accounts, that's defined benefits and accumulation and pension accounts, the whole works. So NCCs do get rather complicated with your bring forwards. You have to be under 67 and you have to have balances like this. What's the easiest way to explain this? So your balance has to be less than $1.48 million at the 30th of June the previous year. If that's the case and you're under 67, then you can contribute $330,000 in that first year and then nothing for the next 2 years. If your super fund balance is between 1.48 and 1.59, then you can only contribute $220,000 in one go. And that covers you for the next 2 years and so on. So the minute you get more than $1.7 million in your funds, in total superannuation, all of your different super accounts as of 30th of June the previous year, then you can't put any more into your super fund. Hopefully that makes sense, but yeah, gee, it's challenging. What it does mean though is if you have, if you've got 1.699999 in your super fund at the 30th of June, then the next year you can still contribute 110,000, even though it takes you over the 1.7. So it's a funny system, and boy, do you have to be careful. This slide in here is just confirming that the point is, say your cap's $330,000 and it's 110,000 per year. If you put in $150,000 in 1 year, you've gone 40 grand over, if you like. That triggers the bring forward rules, and therefore your 3 years time period starts in there. And you've got to make sure that your total contributions over that 3 years only hits the 330. And you can only top up accordingly. So whatever you bring forward NCC cap is, the 330, minus whatever contributions you made in the first year. So in this case, 150 grand means you've only got that much left to claim over the next 2 years. If it's important to you, we'll talk to you about it later. So yeah, just a reminder, must be age under 67. So if you're 66, yes, you can do the 330, but only if you've got less than 1.48 million in your fund. Okay, so just expanding on the total super balance cap issue, this refers to the total value of all of your super accounts. It includes the notional value for your defined benefit accounts. If you've got a normal pension account, then the actual balance of that pension account counts as well as whatever money you've got left in accumulation account. And yeah, the minute you go over 1.7 million on 30th of June, then the next financial year you can't make any contributions, but that means there is some flexibility there. And what that also means is that there are some creative strategies where we might not want to trigger the bring forward this year. We might only want to put in 110 this year, and maybe we do the 330 next year. And that way we get 440 in, especially when you're in the lead up to hitting 67. So if you're interested in using these provisions and you are around that 65, 66, 67 age group, make sure you have a chat to us, because there are actually some tricks to making sure we can get the most in for you. The friendly reminder warning about not going over your NCC contribution cap. So not going over that 110 or that 330K. If you are approaching 1.7 mil, be very, very careful. We get so many clients each year who have the after-tax contributions coming out of their pay, and they forget about it and they go over 1.7, and the pay office is still taking money out and sending it off to the super fund before they realise. So it can happen, unfortunately, more regularly than you realise. So keep an eye on it. If it does happen, option one is that you withdraw all the excess contributions from your super fund. Plus the earnings that you effectively earned on that money that you shouldn't have. And note that those associated earnings then get added into your tax return. Super fund's already paid on them. Option two is that you can actually leave the contributions in your super fund, but then you're going to get charged the excess non-contributions tax flat 47%. So yeah, that's tricky. Sorry. And for those of you who have defined benefit funds, you can only choose option two and pay the tax personally, or you have it accrued and pay it when you take those benefits. So for some of you who might have those CSS or military style of defined benefit funds, we see that quite often, and you'll see there's a special note on your annual statements to say this much is accruing, and it'll be paid out when you eventually take your benefits. So that's all the voluntary contributions that you can make for yourself. Let's have a look at what contributions you can make for your spouse. The easiest one is that there is, you can make a $3,000 contribution for your spouse if they earn less than between 37 and 40 grand. And the advantage of doing that is that you actually get a tax offset in your personal tax return. So they get the 3 grand, but you get a $540 tax offset. That's an 18% rate of return. That's not bad at all. So if you do have a low income spouse, this opportunity is definitely worth considering if you want an extra tax credit in your return. The tricks are that your spouse has to be under 75. Obviously, it has to be an eligible super fund of the spouse that you're putting the money into. It does phase out between $37,000 and $40,000 of your spouse's income. You obviously have to make sure that they haven't exceeded their non-concessional contribution cap for the year. And they have to have also had a total super balance of less than 1.7. So these contributions count towards their personal NCCs and their personal NCC cap. But yeah, that's quite a handy one if you've got a low income spouse for whatever reason, time off or even semi-retired. Another one that we don't see a lot of, but definitely worth considering, is if you do have if you're approaching the 1.7 million total super balance cap, for example, such that you're not going to be able to convert all of that into a pension when you do retire, it's worth considering reallocating and splitting those superannuation contributions with your spouse. And what that does is keep you below the 1.7. Not that there's any major drama with your super balance going over 1.7, just you can't make any more contributions. But yeah, it just helps you even things up. So what happens here is if your spouse is under 67, and if they are over preservation age, then they just can't be retired. But the idea is it's only for your current or the previous financial year's contributions. So you might still be working. Your employer puts in the SGC, maybe you salary sacrifice to bring it up to 27,500. It goes into your superannuation fund, and your super fund takes 15% tax out and sends that off to the super fund. At the end of the financial year, you fill in a form and give that to your super fund. Your super fund takes the 85% left after the tax got taken out, and will roll that 85% over into your spouse's superannuation account. That's good in terms of it tops up their superannuation account. It keeps you below the 1.7 because otherwise it was going to be stuck in an accumulation account anyway. So quite effective way of doing it. What you have to be careful of though is that if your spouse happens to be younger than you, then you just have to remember now that it's in their superannuation account, they can't access it until they've met a condition of release, which might be a couple of years after you. But hopefully if you're already bumping 1.7, then it doesn't matter. For those of you who just like keeping things even and equal anyway, there's certainly no big deal about the 1.7. You can split contributions anytime you like. Just to even things up between you. So that's spouse super splitting. Just remember, it is after the end of the financial year that you can do that form. Okay, let's have a look at other contributions. For a variety of reasons, people sometimes end up in the lower income categories, but still want to top up their superannuation. And this could even, anyway, for a variety of reasons. So as long as you make an eligible personal superannuation contribution, so that's just a voluntary super contribution, one that you're not claiming a tax deduction for, so a non-concessional one, you do have to have met a quasi-employment test in terms of 10% of your income must come from employment or business sources. So for those of you who perhaps have a lot of investment income and a little bit of work income, you might just have to watch that a little bit. You do need to be under 71 on the last day of the financial year and less than 1.7. And obviously don't breach your NCC cap. But the idea here is that if you make a personal voluntary $1,000 contribution into your super fund, then the government will actually chip in another $500. It does phase out though when you've got income between 54 and 56 grand. So it is a lower income kind of strategy, but that's just the government trying to help out, which we won't complain about. What else have we got? I've thrown this one in. It's not a contribution per se, but again, if all concessional contributions, including your SGC, for example, get taxed at 15%, you know, that's terrific when your personal marginal tax rate is more than 15%, but, you know, because that makes it more tax effective. But if your marginal tax rate is less than 15%, the ATO a few years ago acknowledged that it really wasn't very fair that your employer was being forced to put money into your super fund, even though your personal marginal tax rate was less than, say, 15%. So in addition to the government co-contribution opportunity, they've said that if you earn less than 37 grand a year, then the government will actually reimburse your 15% tax direct into your super fund account. So in other words, your employer puts money into your super fund takes 15% out and gives that to the government. When you lodge your tax return and they see that you're a low income earner, they'll give you your 15% back into your super fund. But so it all helps. All right, this one might be of some interest to people. Downsizer contributions. So again, the list of conditions is a mile long, but it's relatively straightforward. If you've owned your own home for more than 10 years, and that's you or your spouse, if you're aged 65 or older at the moment, there is no maximum age limit, and we're hoping that they drop the age requirement to 60 plus from 1 July 22, but that's not law yet. So for the moment, you have to be 65 or older. You are able to contribute part of the sale proceeds of your home into your super fund tax-free. So the super fund gets the money and they don't have to take any tax out of it. It just goes 100% into your account. You don't get to claim a tax deduction for it or anything either, but the contribution amount can be up to $300,000 per person. So what that means is that if it's you and your spouse, well, that's $600,000 from the sale of the house that you can put into your super fund. And that's in addition to any other voluntary contributions. So say you sold your house for $1 million, you can put in 600,000 between the two of you as your downsizer contribution, and then any spare cash, you can perhaps contribute that as a CC or an NCC as well. You have to complete a downsizer contribution form and make the contribution within 90 days of settlement, or of getting the money. The total super balance doesn't matter. So this is brilliant for people who are already over 1.7 mil. Doesn't matter. Throw in another $300,000 each. And there's no work test. So it's a very generous opportunity to top up your super fund at the last minute. Now, some of you might say, well, terrific. I'm not going to end up with $600,000 net proceeds by the time I sell my old house and buy my new house. And certainly what we're finding with a lot of clients is that when they sell their old house and buy a new one, albeit smaller, it's often because it's newer, etc. It's a bit more expensive sometimes even, but it doesn't actually have to be the exact same sale proceeds. So I guess what we're saying is you might have some other money lying around. So even though you have downsized and all of the sale proceeds from your first house have gone into paying for your second one, if you've got other cash lying around, well, you can use that to put into your super fund instead, if you like. Hope that makes sense. But there's certainly some creative stuff that we can do there. Even if the property was a rental property for part of the time, as long as you have been, as long as it was your home for at least part of the time, you're still allowed to use the downsizer contribution. So again, if you want some more specific information about that, just give us a call and we can double check all that for you to make sure you're eligible. Okay, we're doing great timing here. So last but not least, small business CGT concessions. Now, these are horrendously complicated. Don't get me started. Anyway, the issue issue here is, as I've said, they're very strict eligibility criteria. You must talk to your accountant. But the idea is it's worth it because we can basically get, $2 million worth of sale proceeds or capital gain on the sale of your small business completely tax-free if we structure it right. So, talk to us well in advance and we can help you organise this. The definition of a small business means turnover of less than $2 million or net assets less than $6 million. There are complicated rules about the 6 million in terms of what counts and what doesn't, and especially when you own part of a business. So you need to be careful on that front. Obviously has to be assets used in a business because we are talking small business, but that can even include business premises if it's business premises used in your business. And we do have to watch the minimum ownership interest. So for example, you have to own at least 20% of the company, for example, to be eligible to use these concessions. And again, that therefore means that if you're going to phase out of your business, you can go from 100% to 80% to 70% to 50% to 30% to 20%, but do not go less than 20%. Your last 20% has to be sold in one go to make sure that you are still a CGT concession stakeholder and eligible to use these. Otherwise, you'll end up paying tax on that last 20%. There are two options. You can use the small business 15-year and what I've said there and retired exemption, because people sometimes forget that bit. So if you have been operating your business for 15 years and you are properly retiring from that business, then it can be completely tax-free sale proceeds. If you're over 55, you just walk away with the cash, go for it. Or if you're if you're over 55, you can walk away with the cash or you can put it into your super fund. If you're under 55, you have to put it into your super fund, but it is tax-free if you want to use this exemption. There is a maximum $1.615 million contribution limit on that, separate to all those other ones we've been talking about. So that's the 15-year rule. And otherwise, there's the small business retirement exemption one. This one is similar. If you're over 55 and sell your business, the capital, part of the capital gains can be completely tax-free. If you're under 55, they can be tax-free if you put them into your super fund, proportions of them. Some of them are going to be tax-free anyway, but these particular bits that you want to put into your super fund, they'll go in tax-free. But this retirement exemption one, we do have a $500,000 per person lifetime limit, but it still works very effectively. So there you go. There's 10 different ways you can get money into your superannuation fund without breaching any contribution caps and things like that. As I said at the beginning, just remember that superannuation is a long-term investment. It's going to be locked up until you meet that condition of release. So do be careful about making sure that that you don't need the money until then. A reminder that, as you can see from all of those slides, it is dangerously complicated. So many rules for each different type of contribution. You do have to be really careful to get the rates right, the thresholds right, the caps right, the age limits right, the work test right, all that kind of stuff. So be really careful before you make a contribution to make sure you are actually eligible, because otherwise you'll be subject to that extra tax. So in terms of how we can help, if you would like some help confirming your particular circumstances and what you can do, give us a call and we'll be able to confirm that for you. if you want some information about what you should do to achieve your financial goals, be those short-term, medium-term, long-term kind of goals, then you are welcome to give us a call, and we will probably put you in touch with Bob Chen, our licensed financial planner in our Everalls Wealth Management business. We can also help you grow your business. So from the point of view of the capital gains tax concessions, and if you're planning to rely on the sale proceeds of your business, then helping you maximize the value of that. We can definitely talk to you about that and making sure your business is sale ready. To you about self-managed super funds and family trusts. So self-managed super funds, if you've got more than, say, 300,000 in total between you and your spouse, setting up a self-managed super fund can sometimes be appropriate and more cost effective and give you a bit more flexibility with your superannuation investments. And perhaps even for those of you who don't want your money locked up in super, that's fine. Or if you've already, for whatever reason, don't want it anymore in your super fund, we can also talk about family trusts and how they might be effective for you. We can also talk to you about different ways of protecting your assets, given that you've done all this hard work to earn the money and invest it in the meantime. And of course, we're pretty good at negative gearing issues as well. So whether that's rental properties or share portfolios, that kind of thing, we can talk to you about that as well. So there you go. I'm going to just scroll up the questions. Or yeah, does anyone, you can try and unmute yourselves, or
I've got a few questions when you're free.
Yeah, go for it.
The first one, if I can, the small business retirement exemption. Can I just clarify? So there's no limit on the length of time you've got to have owned that business for the second one that you had on that slide. Is that correct?
Correct. But you have to have had it long enough, I guess, to have made a capital gain on the sale of it.
Yep.
Yeah.
Okay, thank you.
There's a 12-month, half of your capital gain will be exempt anyway if you've owned it for more than 12 months, but otherwise, yeah, it's not compulsory for the purposes of the retirement exemption component.
Yep.
Anybody else got any questions?
It's probably worth pointing out that the small business retirement CGT concessions are said by one of the High Court judges to be fiendishly complex, and whatever's in this slide is barely the tip of an iceberg of eligibility. So if you are looking to go down that path, please do not take these slides as anywhere near sufficient.
Correct. Yeah. Did I get, I think Bob pointed out that insurance, if any of you do have insurance inside superannuation products, do have a think about whether that is a good idea or not. As you get older, insurance becomes quite expensive and can chew up a lot of your 27,500 or employer contributions. And so while insurance inside superannuation is often recommended, for example, for younger people or people struggling with their cash flow at the time, it's certainly not recommended further down the track because it does chew up so much of your superannuation. So it might be time to get that reviewed. If you're shy, chuck it in the chat box. I think I've answered all the ones in the chat box, but if I haven't, please just remind me.
I've got a question, Melissa. Sean here.
Yep, sure. G'day, Sean.
Hi, how you going? Great presentation.
Good.
Good to see
Oh,
Rob with
good,
a
thank
tie
you.
on. That's the first time I've seen him without a tie. That's great to see as well.
Yeah,
The
I at least put the
non-concession.
company shirt on.
Yeah, well done. Good on you. The non-concessional avenue that you spoke about, I'm assuming that's, you know, contributions from your employer. But if you were to, if a family were to come into money
No.
at home,
Sorry, non-concessional is personal contributions that you're not claiming a tax deduction for.
yes, yeah. So
Yeah, okay.
would you, if you were to say sell your family home, and all the tax concessions are finalised on that, are you able to use that avenue to put money into your superannuation?
Yes, so if you sell your home and, for example, you're not eligible, well, regardless of whether you are or you aren't eligible for downsizing, use that to make a non-concessional contribution into your super fund.
Yeah.
If you're eligible for downsizer, you would want to use that option first, because those contributions don't count towards your NCC. So that's what I was saying. You do your first 300,000 using the downsizer, and then if you've still got any spare cash, then you'd put it in as an NCC contribution.
Yeah, but you would still potentially be pinged for tax on that as it went in.
No taxes on non-concessionals.
Yeah, okay.
Because it's already out of after-tax money.
Yeah.
It's already been taxed.
All right. Yeah. All right. Thank you. More to think about on that one.
That's all right. Yeah. In theory, if you could put in 300,000 using the downsizer contribution and then do a bring forward on your non-concessionals of 330, you'd be able to put $630,000 each into your superannuation fund using, in theory, the sale proceeds from your house.
Yeah. Okay. All right. That's great. Thank you.
You're welcome. One new message. For external. Super. Linda, sorry, your question. So if you've got insurance inside a super fund and you pay your premiums into this, you pay superannuation contributions effectively into your super fund, and the super fund uses that money to pay the insurance premiums with, the question is whether you're claiming a deduction for those superannuation contributions or not, assuming you're paying them personally. If you are claiming a tax deduction for them personally, then that makes them concessional contributions, and therefore they count towards the 27,500. If you're not claiming a tax deduction for those superannuation contributions, then they are non-concessional contributions, and then they count towards the $110,000 instead. Does that? Terrific. What I haven't mentioned here is that when you do a personal concessional contribution, the super fund normally sends you a form at the end of the year that you have to fill in, a notice of intention to claim, to let the super fund know how much of your personal contributions you're claiming as a tax deduction. And that's where you'd be telling them whether you are or you aren't claiming a deduction for them. Gary, yes, the spouse super splitting usually only applies to the concessional contributions, because the non-concessional ones are voluntary and paid by you personally. So if you want to, you just put them into your spouse's account in the first place. You don't bother putting them into yours and then moving them to hers. If that makes sense.
Yep. Yep.
Cool. Any more?
I do have one other question, if you don't mind, just quickly.
Yeah, go for it. I can sit here for as long as the internet holds out.
Some of the limits, like the 500,000 for the catch-up concessional contributions and the 300,000 for the work test exemption, aren't particularly high. They're not exactly allow you a luxury retirement. No. Are they likely to be increased over time? Do you know? Is there any noise on that?
No, I wouldn't hold your breath on that front. It's taken us, what, 3 or 4 years to get the 25 grand index to $27,500. Unfortunately, no, it just means you'll have to make the most of your 27,500 at the time every year. So, I often tell the story of in the old days when marginal tax rates were 60% and all the rest of it before my time. Superannuation was very much left to the last minute. These days, you have to do the slow and steady approach. You have to make the most of your contribution caps every year because it is so hard to get it in later on. Yeah.
Yeah, thank you.
Gary, just to address your question as well, unfortunately, a lot of the caps are hardwired into legislation. They haven't put an indexing module against them. The 25 going to 27.5 and the 100 going to 110 are actually the two exceptions. Most of the rest of the caps are hardwired in, which means to change them, they've got to change legislation, and you know how tough that can be. So, will it change? There's two certainties in life, death and taxes. And in the second of those certainties in taxes, will superannuation laws change? Definitely. When and by how much, and whether that's in your favour or against, that's an entirely different speculative conversation.
It won't be regularly.
If any of you remember family trusts and the $416 that kids were allowed to earn tax-free, that hasn't been indexed in 30 years or something, so don't hold your breath. Yeah. All right, well, look, as I said, I'm happy to sit here for as long as you guys like, so if any of you are shy, just hang around a little bit longer or put it in the text box. Otherwise, for the rest of you, thank you so much for joining us. Much appreciated, and I do thank the man upstairs for my internet holding out as well as it has, or hopefully as well as it has. So yeah, thanks very much for joining us, and feel free to flick us an email if you've got any queries, if you think of anything later on. Okay, thank you.
Thank you.
Apparently, I have the power to end the meeting for all, Melissa, so I might do that.
All
Somebody
right.
wants to jump in. Just discovered that. So well done. We'll see you tomorrow sometime.
Okay, thanks. Bye.